So I'll take a minute each to introduce all of the eminent speakers we have present here. I'll start with Mr. Anurag Agarwal. Mr. Anurag Agarwal is the partner at Avishkar Group. He has worked with most of the microfinance institutions in India, and he has played a key role in incubating I3N, which was the India's first impact-focused angel network. And he has been the key architect for creating the whole Avishkar Group. Thank you, Mr. Anurag Agarwal, for joining the session. Next, we have Mr. Abhishek Agarwal. Mr. Abhishek Agarwal is the Action's Chief Regional Officer for South Asia, and is responsible for overseeing Action's operations in the region. Mr. Abhishek has also served as a CFO for more than 12 years in several countries, including Swadhar Microfinance starting in 2010. He comes to Action with an extensive experience in financial management, strategy, and business planning and microfinance operations. Prior to that, he also acted as an advisor to the Institute of Chartered Accountants. Thank you, Mr. Abhishek, for your presence. Thank you so much. We have Mr. Rishabh Pagre from BCP Advisor. He is a senior banker with more than 15 years of experience across investment banking and private equity. At BCP Advisors, Rishabh is responsible for driving Indian operations, which include from deal sourcing analysis, valuation, due diligence, portfolio management, and exits. Rishabh has a postgraduate diploma in management from the Indian Institute of Management, Kozhikode, and he has a BTech from NIT Bhopal. Thank you, Mr. Rishabh.
Thank you.
We have Shikha Gupta from Elivar Equity, who is the Director Investments at Elivar. Shikha brings 13 plus years of experience pertaining to various aspects of finance, from controllership and business finance to group oversight. Prior to Elivar, she was with Fidelity International, where she held global roles. And she has also worked with 8 Road Ventures, where she was a senior member of the finance team, managing portfolio valuations, audit, and working closely with the investment team on the investment and divestment activities. She started her career with EY in their statutory audit division. She has always been passionate about impact. While working with Fidelity, she was an important member of the CSR team, partnering with NGOs and contributing towards establishing a process for providing meals to shelter homes and private schools for underserved children. She is a chartered accountant by qualification. Thank you, Shikha, for joining the webinar. Then we have Mr. Shreyansh Chandak from Village Capital. Shreyansh heads programs and partnerships for the South and Southeast Asia at Village Capital, which is an entrepreneurship support organization involved in capacity building programs for impact entrepreneurs. He has worked with close to 120 plus founders across South Asia, supporting them in their fundraising and business development plans. Shreyansh has also a key interest in the non-profit sector. He has worked with several NGOs in the past in the field of education. First of all, I thank all of you to take out your valuable time and share the insights on the financial services sector. Now, I'll be starting with the topic. Rohan, if you can run the PPT. Impact of VC investments in financial services sector. Impact investing are the investment made into companies, organization, or funds with an intention to generate a beneficial and measurable social or environmental impact without compromising on the financial returns. Many are familiar with the term, but still there is an increasing awareness that impact investments provide capital to address social or environmental issues. So today's topic of discussion are going to be investment in financial services sector. We'll also cover the subsectors where the investment has taken place. Then we'll also cover the investment highlights which has happened in the past decade. Then impact investments which have taken in the financial subsectors in NBFCs and HFCs and MFIs. Then recent funding rounds in impact organization in the last 18 months, 24 months, which have taken place. Then myths about impact investments. Many people are still not aware of the concept of impact investment. Then how these companies try to create a value and how they impact to the society. And finally, we'll wrap it up with a conclusion. So investments into financial services sector have grown at a 19% CAGR and an account for 50% of the total capital deployed in impact investing over the last decade. So this is the complete trend of the PE, private equity, and venture capital investments which have taken place in India. So we can see that the graph has consistently gone up and it is growing at a CAGR of almost 19%. We can see in the 2020, suddenly the graph has gone down. The number of investments have gone down, which was due to COVID-19, which happened in March 2020. Financial services sector has been the largest sector in terms of value and deals, and third largest in terms of number of deals for PE VC investments, with over 37.5 billion USD invested across 910 deals. Private equity VC investments in financial services has grown from USD 775 million in 2011 to a high of $9.1 billion in 2019, which is an 11-fold increase with an exponential rise in both value and the number of deals. So this shows us the importance of investments in financial services sector, how VCs have evaluated these opportunities and they have decided to go ahead with that. Next scroll. So this is a breakup of the different subsectors where the investments have taken place, investment percentage wise, and the number of deals which have happened, the amount of money has been flown into these sectors. From the number of deals perspectives, fintechs and payments accounted for almost 28% of the deals in the financial services. Insurance is another sector which has gained favor from the PEVC investors, recording USD 5.8 billion in investments in the last decade. So we can see the NBFCs has received the maximum amount of capital from the venture capitals. In percentage terms, it is 32% and it is over USD $12 billion. Then if we talk about the number of deals, then again, NBFCs is leading the chart with 359 deals in the last decade, 39% overall. From the number of deals perspective, fintech and payments have secured for 28%. Now this is expected to further increase, aided in part by the recently proposed increase. So we know that a few years back, the FDI insurance sector was increased to 74% from 49% earlier. So in the last 1 or 2 years, we have witnessed an increased interest specifically in the insurance sectors of the alternative investments. NBFC sector was the largest subsector for investments, both in terms of value and volume, accounting for more than a third of all financial services sector PEVC investments by value and volume. Next, Rohan. So these are the investment highlights of the last decade. So we have top funded startups in the financial services sector. So MoneyTap, it's a fintech company and got a funding of USD $70 million. Then we have Incred, which is a SME finance, Khatabook, Navi Technologies, iFinance, which also recently got funding, Veritas, Lending Card, Finova Capital, SME Corner, Centrum Housing Finance. If we talk about the value of volume of investments across financial access subsectors for the last for 2019 and 20, in CV finance we had 2 deals, which is I think the minimum number of deals along with housing finance. Then the maximum number of deals happened in SME finance, amounting to USD $310 billion. So overall, $700 million was infused across 50 deals in 2019 and 2020. So here is a snapshot of 2019 and 20 investments which happened. So $1,390 million invested across 81 deals. Aptus Value and Aadhaar received over $230 million in total. MoneyTap in 2020, MoneyTap and Khatabook received over $130 million in total. A total amount of USD 699 million was invested across 51 deals. The other companies which got funding were Lending Card, Veritas, iFinance, and received over 130 million USD in total. Next, please. So 156 enterprises offering a range of customized financial products to the low income have enabled financial inclusion for $96 million. So we have added this part to show that how the different subsectors, how different companies have tried to create an impact among the lower sections of the society. So first subsector which I'll take is microfinance. The challenges they faced were micro entrepreneurs rely on informal sources of borrowing on their ventures. The amount of impact, if we talk about the amount of impact they have created, is USD 64 million. One of the examples is Ujjivan Finance Bank, or Ujjivan Finance, small finance. Then from SME finance, the impact created was around 22 million. And one of the example which got funded in SME finance was Kinara Capital. In vehicle finance, we had Wheels EMI, which created an impact of 0.32 million. It's a niche NBFC providing customized financing for pre-owned two-wheelers. Recently, if we talk about vehicle finance, recently Kokta Financial, which is a Jaipur-based company, also got funded few months back. Coming to housing finance, in the Umeed Housing Finance has created an impact of 0.4 million. Then in fintech, we have SmartCoin, which has created an impact of around 9 million. Financial inclusion, undoubtedly the biggest success story of impact investing in India so far, saw cumulative investments of 5.5 billion USD across the decade, across 156 enterprises. Next. So these are the recent funding round in impact organizations which have taken place. So recently, Shubham Housing Finance got raised a funding of $112 million. And I would like to tell you that Elivar Equity has been associated with Shubham Housing Finance for, I think, from 2010. And they have been, I think they were the first institutional check of Shubham Housing Finance as well. And the other investors who were involved in were British International Investment, Leapfrog, Asian Development Bank, and Premji Invest. Then we have Kinara Capital, which recently raised 50 million USD. Nuveen and Triple Jump were the investors. Pinova Capital, which raised $65 million. Then Aviom, which recently raised $8 million. Veritas Finance raised almost $60 million. India Shelter Finance Corporation raised $15 million. Varthna raised recently $14 million. Investors were Kaizen Private Equity, Link REIT, LGT Venture Philanthropy, Omidyar India. Then other few companies which recently raised are Sarvagram, Origo Finance, Sevagrit, RIN Limited, Home First Finance Company, and iFinance. Next. So many people believe that the investors who are investing in these impact organizations, they have to compromise on the returns, but that is not the case. So we have added this particular part to dispel the myths about investing for impacts. Impact investing still has a long way to go as investors continue to struggle with preconceived notions and biases. Our analysis has led to a few counterintuitive insights. So impact investing means lower returns, which is not true. Impact investments have ranged from minus 46 to 153% with a median return of 10%. It may come as a surprise that the top 1/3 of deals yield a median IRR of 34%, which is a pretty good number. Patient capital is a necessary prerequisite. Holding periods at exit have been about 5 years, in both average and median term, which is not a very long time. We have witnessed that on an average, a VC tends to stay in any organization for a range of 5 to 10 years. Obviously, that varies from VC to VC based on the thesis and objectives they have. But again, the range is somewhere between 5 to 10 years. Investing for impact is for impact investors only. Impact funds were the first investors in 62% of all deals and in 8 of the top 10 microfinance institutions in India. Now, this led to traction from conventional PE and VC funds, even as business models of underlying assets industries mature. Social enterprises backed by impact investors are small investments whose impact is a drop in the ocean. Impact investments generated a median gross IRR of almost 10% in dollar adjusted terms. More significantly, they touched the lives of 60 to 80 million people in India about the size of the population of finance. We believe that impact investments have the potential to grow 20 to 24% a year between now and 2025, reaching a USD $6 billion to $8 billion in deployment. Next. So this is how the companies have tried to create an impact. So problem and opportunities. Workers in the informal, they have identified the problems and opportunities. Workers in the informal economy lack credit histories. Then the inputs, they conducted a detailed legal verification of property. They went through the rigorous detailed legal verification. They worked on building brand awareness, providing home loans to the informal segment. The output came was increased access to credit, improved knowledge about their property, increase in literacy, and increased awareness. The that was the outputs. The outcomes was everyone improved their financial management, their housing tenure security. The overall, the end impact created was the companies were able to successfully provide access to credit to first-time loan borrowers. They enabled asset creation. They created a better environment for families, health and education, and improved living standards. Understanding and describing the impact. So providing the impact can be explained in these many ways. Providing access to credit for first-time borrowers, enabling asset creation, improving living standards, creating a better environment for family, health, and education. Next. So finally, we'll be wrapping up this presentation by concluding. Impact investments have come a long way over the last 10 years and already made a meaningful contribution to India's development story over the last decade. So these are the few highlights of the impact investments in financial services sector. Indian impact investing has impacted 200 million people through improved service delivery across 4 key social sectors: financial services, health, education, agriculture, and further 300 million people through the strategic use of technology for development. Then 10.8 billion of total equity capital has flowed in over the decade at a CAGR of 26%. Traditionally focused on financial services, Indian impact investing has successfully diversified into core social sectors like agriculture, healthcare, and education as well. Impact investing has contributed towards 11 of the 17 sustainable development goals and can help unlock part of the $600 billion of additional private capital needed. Yes, please, next. So this is the financial highlights and the highlights of the impact investments. Now we have few questions from the eminent speakers. I'll be going with Shikha Gupta first. So Shikha, being an impact venture capital, how do you measure the value of an impact created by your portfolio companies or any other companies from other VCs? So how do you measure that value of impact?
Sure, Rajaswa. Thanks. A very interesting question. And thank you for having me here today and talking about impact investing. So when we talk about impact, right, and we talk about impact created by portfolio or any other company, our thesis is that, impact and commerce kind of goes hand in hand. Impact and business goes hand in hand. So we do not track impact and business metrics separately. When we talk about impact being created for underserved, unserved segments of the society at scale, both the commerce and impact metrics kind of converge. So impact is core to the portfolio companies which we invest in, and we track these metrics on the basis of community, business, and scale. And we do not have separate metrics to identify, the growth in business on a one direction and growth of, or, just kind of assessing impact on the other direction. Because impact is core to our thesis, all the metrics, if they are kind of, working towards the business growth, add to the impact. For example, when we talk about scale, right? So if you have large number of customers being served as part of the impact metric, that also kind of feeds into your business and P&L in terms of scale and growth perspective, right? Community, if you're kind of talking about your customers, the business's customer segment as the underserved, right? So how many number of customers are you able to kind of target in that segment, which also fuels your business growth, right? And then we talk about community. What is the repeat business, which you're getting from these customers, which on one hand is helping these or enabling these people to kind of come back to you, and on the other hand for the business is a stickiness metrics for that. So we kind of look at impact and business metrics with one lens.
So I think you gave a very good idea about this. So you have few operation matrices set, which takes care of the impact created by the organizations or by your portfolio companies.
Yes. Yes.
Thank you. Now, businesses, the other question for you, Shikha, we have is, businesses struggle with attracting capital in the early stages of a company's life cycle. So how should one go about raising private equity funds early on? We have seen so many founders, entrepreneurs struggling with this thing. They are unable to approach venture capital. They are unable to approach venture capital funds, or maybe they are still not ready with that. So how they can go ahead with this? How can you help?
I can talk about it in two, aspects. I think one is more how do we, as in like how Elevar looks at opportunities and entrepreneurs and, companies. And then I can kind of talk about more generic sense also. Given we invest in businesses which are more targeted for underserved, unserved segments, right? We take our bet not on unproved models, but we take our bet more on the entrepreneurs who are wanting to do this. So we bet on experienced entrepreneurs who have had certain, a life journey, who are able to now kind of contribute to, disrupting a certain segment, and which can kind of, create impact on the ground. Not to say that people who are out of college or who are kind of recently starting businesses will not be able to do that disruption, but that's just the lens which we apply. So we take a risk and bet on the entrepreneurs, and then kind of, look at scaling up unconventional business models towards this segment. When I talk about general, right, what do people need to kind of keep in mind when they are approaching VCs and PE funds for especially for early stage capital, is not to only have a consultation or consultancy based business model, right? They need to have a ground up customer based approach, know their customer and what they are targeting to build. It should not be a Excel model. They should be thinking about the org, team structure, because that is going to be very important for their journey, right? They need to be having a deep rooted understanding of the environment, the ecosystem, and the ground up customer thesis of the business they are wanting to build. So it should not be approached from a boardroom P&L balance sheet kind of view. It should be approached from a ground up view. And the people who are able to kind of think through that, are I think the business models they put up are able to get funded more quickly versus the others.
Yeah, that's great. So I'll just try to summarize your answer once. So from the point of Elevar Equity, you mentioned that you look for the experienced founders, experienced entrepreneurs who have the vision of creating an impact in the society, right? And if we talk about general, then you are more, then according to you, VCs are more interested in the team, the founders, their approach towards the market, towards the customers, more than the financials they have with themselves.
Yes, because if you have a strong team, right, the business model can follow, because business models will evolve, right? But if you have a strong executional capability and ground up approach, you're able to kind of navigate through the challenges.
Right. Thank you, Shikha. Those answers were highly insightful. Thank you. Next, we have Mr. Anurag Agarwal from Avishkar Capital. Mr. Anurag, if you can unmute yourself, please. Thank you. So, what are your views on investments in financial subsectors such as MFIs, NBFCs, HFCs? And what do you think, where is the most of the capital inflow is going in the current scenario?
Thanks, just for the question and for having me on this panel. So it's a fairly broad question. We as Avishkar have been around for 20 years. And we have been very active in the financial services sector investing. So we have invested in MFIs. We were one of the early investors, so have invested in a large number of MFIs. We have also invested in financial inclusion across other sectors, so NBFCs, MSME financing, housing finance companies, neobanks, insurtech, so wide variety of sectors. So I think all of these, by definition, are very large spaces, right? So the opportunity for scale is available in all of these, right? They are all at different points of time, at different levels of penetration. Like for example, 10-15 years ago, microfinance was a very new area. Very little capital had gone into it. Today, it's a sector which is close to about 3 lakh crores in terms of overall size. So apart from impact investors, a lot of mainstream capital has also gone into it. Also, penetration levels are very high, right? So depending on the nature of capital that one is managing, the entire spectrum is open. All of these are very, very large opportunities. Some have become slightly more mature, like the microfinance example that I gave. Some are slightly more nascent. So we are seeing a lot of activity in the HFC space, in fintech lending, in MSME lending. Again, these are perhaps much larger opportunities if you look at the overall market potential point of view. So obviously, new models are being developed. Some of them are not yet proven or are going through some difficult situations, especially in a post-COVID environment. So capital is also being cautious, and I think what is clearly getting differentiated is those who are able to manage their asset qualities are able to attract a lot more capital. So you are clearly seeing more capital moving towards secured models as opposed to unsecured lending, which was happening a lot more earlier because you could grow much faster there. So people are clearly allocating more capital towards better asset quality as opposed to higher growth, which was what we were seeing in the last 4 or 5 years, right? Mostly it was more focused on growth. And obviously, the tech is a huge enabler, is a huge, if you have deep tech integration through which you are able to do more efficient operations, or you are able to take better credit decisions, then that itself becomes a differentiator to attract more capital. And like Shikha said, right, in these kind of businesses, the human element plays a very key role because these people are finally custodians of capital, both equity and debt. So the fact that have they got a track record of doing this at scale earlier, what's their track record from an ethics integrity point of view becomes extremely crucial when it comes to money, because we've seen many large institutions going under because of these issues. So I think background checks around those things in sector do matter.
Thank you, Mr. Anurag. So again, so Avishkar has been in this for more than almost 20 years now. And you have seen, you have invested in almost every financial subsector, which you mentioned, ranging from HFCs to NBFCs, SMEs, MFIs. So you mentioned that if we talk about 5-10 years back, then the interest was much more in MFIs, if I'm not wrong. And currently, you mentioned that it is in a mature situation now, and fintech and HFCs are more in the nascent stage comparatively. So we can expect more capital. Can I say like this, that we can expect more capital going into HFCs and fintech in the next 5 to 7 years?
See, I mean, well, I said that this continues to grow, right? So it's just that the nature of funding is changing. As you can see, many of these companies have got listed, so even retail investors are investing, right, in these companies. So the nature, and some of them have actually gone and converted themselves into banks. So it's actually depositors' money which is actually funding some of that growth, right? So by definition, all of them are very large spaces, and those who are able to demonstrate strong unit economics, good asset quality, and are able to stay the course, show some differentiation from a tech new age technology etc point of view, are able to attract a lot more capital, and that capital itself in some ways becomes a differentiator. Those who are able to attract larger amounts of capital are able to deploy, have better teams around them, are able to invest in technology more, and then they are able to also grow much faster as well. So that itself becomes a differentiator at that point.
Yeah, just want to share one more. So a few months back only, we saw there was a direct message from the VCs that now growth is secondary, but profitability has to be there, which was termed as winter coming for the startups. Right? Okay. Thank you, Mr. Anurag. So according to you, what are the return expectations of a VC while doing an impact investments? So is it same like other investments, or is it different when you are considering an impact?
So it's a much debated topic. See, most of the impact VCs are also raising capital mostly from similar sources as mainstream venture capital funds. So most often you will find the return expectation also similar. I think where the differentiation comes from is like Shika was mentioning, that typically impact VCs will specifically look for intentional impact, or the nature of customers that these entities are facing, right? You are going into perhaps sometimes areas which are unproven, underpenetrated markets, underserved markets, business models that have yet not been proven, right? So to that extent, a mainstream fund or a technology fund or a larger investor may shy away from taking those risks. So one can say that perhaps these funds are taking higher risks. But if those risks pay off, right, then the returns, the actual outcomes in terms of returns could be actually higher, which is what some of your data was corroborating as well,
Yes.
right? So it's not like the return expectation is any lower. I can tell you that when we underwrite investment, at a gross level, we are expecting to generate at least something like a 30% gross return on each investment, right? So this is, I don't think, any different from what one would find in mainstream.
Right. So it's just that you do some extra efforts. You go, you do some extra efforts and try to create an impact through that organization.
No, I'm not saying that these other funds don't do that extra effort. Perhaps again,
okay, maybe
activity is similar. It's just that the mandate of the capital that the impact funds are managing is slightly different, and therefore they will go in certain areas where maybe other funds will not.
Okay. Got it. Thank you. So one more question for you. What have been the significant achievements of impact funds in India, and how have they impacted the lives of the underserved sections of the population in India specifically?
I think this question you already answered in your presentation, so you have a lot.
So if I can, if you can summarize it, or if the audience can hear you from your side for a minute or two.
No, so I think the key achievement of impact funds is that 15 years ago this category itself didn't exist, right? People were mostly investing in 4 or 5 cities of India. Capital was very limited to So I think one of the key achievements of impact investing has been the fact that you are able to democratize that capital. You are able to take it to far-flung areas. A larger number of people are able to access that capital. Both in terms of the kind of entrepreneurs who are getting funded and the end beneficiaries that are actually receiving the services and activities that these entrepreneurs are doing, right? So I think in terms of outreach, what it has been able to open up, I think that I would count as one of the key achievements. The second thing I would say is that when it started off as a movement, it was considered as a experimental activity, something on the margins. Now, if you look at these sectors, right, whether it is financial inclusion or agri or even climate, these are no longer sectors on the fringes, right? So some of the people who were early pioneers in the space were beginning to do this with very little amount of capital, little experiments here and there. That no longer happens. So the fact that these impact investors have been able to invest and generate return on their capital, have been able to demonstrate that this actually works, has actually had this multiplier effect where a lot more capital has moved in, and these are no longer activities on the market.
Thank you, Mr. Anurag, for answering these questions. Next, we have Mr. Abhishek Agarwal from Action. So if you can unmute yourself. So for you, how has been your experience or journey of the complete investments from the evaluation to investing, from sourcing to investing? How has been your complete journey in investing in your portfolio companies?
Thank you very much, Ojaswa, first of all, for having us on this. This is very useful, and I can see that you have got all the PEs and impact fund investors here giving the wisdom to and sharing their thought processes. So very, very interesting. Quickly, just a minute. I think as an Axion, we invest only in financial services and fintech companies. have a history and track record of investing for close to 30 years. Otherwise, an organization, we have been there in the business for last 60 years. And one of the unique thing as an Axion, which we are able to do, are able to invest from very early stage startup companies from $100 to $200,000 all the way up to Series B, Series C capital, which is $15-20 million check sizes as well, and which is a very unique propositions from the investments perspective in the financial services space, because then we get to see the entire life cycle of the company, and we have the flexibility to enter into the companies at different stages and can help them grow through that. Coming to your question, I think what has been the journey and how we see it, there are two phases to it. One is pre-COVID and one is during COVID. And I think pre-COVID, everybody knows how the world used to operate. I think the most interesting for this group would be to know how this journey has been during this COVID period and how this continues to be out there. I think what we are seeing is that as an impact investor, the understanding and knowledge towards the market and what has been happening in the market is very, very important. We as an Axion have our global footprints. We are a global investor, and we continue to see how these models are evolving, how these are emerging. So having that understanding, how the ecosystem, how these models are emerging becomes very key important. And that plays a significant role in terms of looking at the selection of the company. Shikha already highlighted, it's not about the Excel sheets which gets presented. It's about the gut check on the entrepreneur, and that gut check really comes about their deep understanding of what are they wanting to do, how are they wanting to do it. So in that angle, I will put it, what is the problem you are really trying to solve? Has this problem been solved by others? And if this problem has been solved by others, what was the angle and approach which was being taken by the other entrepreneurs, and how you are going to be differentiated from there? Then looking at the angle of really in terms of how solid the team is. As I mentioned, we as Axion have the flexibility from very early stage to the growth capital, later stage. So I think the evaluation changes based on where and at what stage I'm looking at the company. But these two parameters would always be there. And then coupled with it is, I would say, how I think Anurag talked about in terms of the transparency and integrity. I would also put the emphasis on the governance, particularly when you are going into the growth capital companies, how the governance is really playing the role into these companies. And within that governance, how good the independent directors are playing the role. So as we look at the selection of these companies between the various buckets, I think we play a lot of emphasis looking at where the companies are, what has been the track record, how the governance is playing the role, who all others are on the cap table. And then one thing which is very, very important, core to our heart, being the impact investor, it's not only our capital, but what else we can help the company and the management team in this. And in that, one, as a shareholder and as a board member. Second, we also play our role in these companies from a demonstration effect, where a number of our team members come and work with the management team, with the promoter, in helping in creating these model as a demonstration model, which then can become and attract more and more commercial capital, private equity, which was being reflected on some of your slides. So I think we play a lot of emphasis to see that in our selection criteria, that how this company is looking at the value addition expectation from the investors. Is it really towards the only capital and in turn the valuations, or there is something plus the expectations of the promoter? And once we go through with those filtrations, I think we look at it. Part of it has been quite tricky during the COVID times, as you continue to see, and companies are struggling in this period. I think your chart was showing how the capital inflow has dropped significantly. And I think that trend will continue to be there for some time. But now the markets have opened up, so you can start to have the access to these companies. And I think in this period, it also talks about your ability to underwrite these companies with your deep sector expertise, so that even when you are not able to travel, you can form a view. You can form a view on the company. You can form a view on those models and have the ability to write that check. And that comes with mixed of, I think Anurag was touching upon, ability to underwrite the risk, because I think impact investors have a larger appetite to underwrite the risk, and that's where the reward also comes. but also that sector expertise, ability to understand and go with the flow while the times are difficult, how one can come out, take the advantage from a pricing perspective, but also give the capital flow to the entrepreneur so that they can continue to sustain their journey and build the models.
Thank you, Mr. Abhishek. I would like to highlight one point from your answer. So you rightly mentioned that VCs brings a lot much more than the traditional ways of finance on the table for entrepreneurs and startups. Apart from the capital, the way you mentioned, apart from the capital, they bring along a lot of expert experience, which you guys have, a lot of management techniques. So that is a very positive point for the entrepreneurs and founders to, apart from the capital, they get much more from getting the VCs on their cap tables. Thank you. Now, another question for you is, how has the impact investing ecosystem evolved in India over the past few years? Since you mentioned 2-3 times about pre-COVID and post-COVID, I would love to hear you what has been the changes and how is that evolved in the last few years, and what are the changes pre and post-COVID?
No, thank you very much. Again, this is a very interesting and I think hot topic right now going around in the impact investors and in largely the investors community. I think given that now, if you look at it, how the era has been evolving, we are still in the evolution. A lot of emphasis has been coming on in last few years, and more particularly in last 2-3 years, towards the ESG framework. And India is still at a nascent stage. I think all of us as an investors have started talking about the language on having the view on the ESG compliances. Companies are still struggling, scratching it, that what they need to do. So, and it is quite critical. I think if you are able to have the some of these ESG angles being implemented into the companies, which includes either the climate angles, carbon footprints reductions, and some of those, then your cost to capital or the cost of financing can also come down significantly in some of these companies and some of these models. But I think, as I was touching already earlier, that we in India are seeing an evolution. Are we there yet? In my sense, no, not yet. But I think the Indian industry from both sides, from an entrepreneur business model side, as well as from an investor side, both, it has evolved quite a lot and continues to make the right noise, as well as putting the right steps into the right direction in order to show what has been the impact. I think you were presenting, which on your own slides, that what has been the dollar impact being created, what has been the outreach from some of these the impact capital. And I think those are the initial steps being taken in that direction. I think the real success would really come out when we as a country are able to demonstrate how we as the India as a country, impact investors as a community, and entrepreneurs have been able to meet these UN SDG goals. If we are really targeting $30 trillion as an economy by 2030, how are we taking these steps forward towards it in terms of reaching those numbers, defining these into the small broken steps which we can reach. Anurag touched upon this from an integrity ethics perspective. We keep on hearing from some of these big listed institutions how, because of the integrities, because of the transparency, things starts to fall flat. I think which is where it is very important that how are we putting the fundamentals in place, and we as a nation, as a country, have to still achieve a lot. Steps have been put into the right direction, and I think still a lot needs to be done. Coming to your comment on from a pre-COVID or a post-COVID perspective, I will even spread that era, given we are a financial services investor, and I will take a minute more on this. If you really look at it from an MFI perspective, I'm sure there are a lot of practitioners here. Look at it, what was happening during AP crisis in 2010 versus where the industry is today. Industry is far more resilient, far more strong. Anurag talked about 200,000 crores rupees into the microfinance sector itself. So if you look at it, what the AP crisis did really made the sector more resilient, more strong. But what went into it was fixing the nuts and bolts of the industry. Earlier, the rules of the games were defined, but everybody was playing the game as they wanted to play. I think what is important is here, as a community on both sides, understanding the relevance that why these are important. I think we as an impact investors keep on emphasizing it. And sometimes some of these gets diluted as the companies gets large, as the private equities and others comes to the play. It is very, very important that we keep the right balance in terms of looking at the outcomes, what has been it for, and that's when the journey becomes meaningful.
Thank you, Mr. Abhishek, for the insights. One last question for you. So, what are your views on exit management in the current scenario? So, we have been listening a lot about this, the exits, ways of exits, possible ways of exits for the VCs, private equity. So, what are your views in the current scenario?
So India is still a fantastic market for exits. I think given we handle a global portfolio, we see this challenge in the other markets. And as I discuss all these in the Indian perspective, I think we have a lot more options. But coming, I think, looking at the exits and given where we all are, I think exits are going to be slightly tricky and challenging in some time. All the companies are looking at buffering up the capital at their end. But to come back to your specific targeted questions, what are the different ways of the exits? At least what we hear is everybody talks about the IPO as the first exit option. And that's not the way. You've got to be practical and pragmatic. Not every company can go and list themselves. It's good to be aspirational on that front. But as we hear from the entrepreneurs, the first exit option, they come and present us, let's go and list ourselves in 3 years, 5 years. Listing is not that easy, and not every model can be a fit for that listing. So I think you've got to be pragmatic, practical, how long you are there into that business, and what are the other options you can look at it. India is such a large market which offers the variety of the opportunities in terms of looking at exit, whether it is strategic, whether in terms of the secondary sales, and given you can keep on seeing the requirement of the capital in these business models, unlike into the global market, where one sees the capital raises happening every third or fifth year. Here, I find companies raising the money every year or so. So I think it just offers the various opportunities. It's just that we also got to be pragmatic and practical, than only targeting towards the IPOs.
Thank you. So that sounds great. As you mentioned that in India, the scenario is much better as compared to other countries about the exit management. Thank you, Mr. Abhishek, for your insights. Next, we have Mr. Rishabh Fagre from BCP Advisors. So, a few questions for you, sir. What are the recent VC investment trends in financial services sector in India, according to you?
So, first of all, thanks a lot. You can hear me, right? Or just
right? Yes.
Hi. Thanks for having me here, and with eminent panelists Shreya and Shikha, Anurag and Abhishek. Thanks, everyone. In terms of our investment philosophy, we are not really impact investors. We are financial services focused, and we believe that with our investments into the sector, financial inclusion being a core of our thesis, there is an impact which is created. And as you understand that funds come at different life cycle stages, so some of the funds would invest at early stages, and perhaps we might be the ones which could take them out as their exit options, as Abhishek was saying. So it's not like you have always the IPO as an exit option. You start a company and really looking at a scenario where 5 to 6 years you would be able to list it. Perhaps very few companies would have been able to do it, maybe 1 in 100 or something like that. Now, interestingly, on an overall funding scenario, vis-a-vis 2020, where a large part of the funding was still because of one large telecom player getting investment into India. In 2021, I think around $77 billion were raised in India. And a lot of them were, there was no chunkiness in that sense, of which I think about $11 billion went into financial services, which is a significant amount. And fintech also continued to attract a large part of capital. Now, why that is happening is because of, I think over the last few years, you can say that India is undergoing a rapid change. Maybe 2013, 14, when, or maybe you can even say that, when we started adopting Aadhaar as a platform, which then transformed to UPI, and then then getting even more mature in terms of a platform. By 14, 15, you had then following demonetization, then more deregulations and focus on getting BEAM, UPI, that sort of focus. Then also supported by the fact that the telecom data rates came down significantly. I think we are seeing a significant change in the ecosystem, and that is what is leading to emergence of fintechs, which are disintermediating the existing brick and mortar, I would say, infrastructure which is there. So much so that now there is a stage where existing banks also can only grow and survive if they adopt technology more. So it's not like big bank, I won't name them, but they are also now totally into the technology, investment into technologies which were possibly slow in around 2010 to 15. Now they are also rapidly investing in that platform. So then in terms of an overall trend, we are clearly seeing that more and more companies which are adopting technologies, they are and then mixing with the financial services, they are getting more funding, be it the payment space which started and now even the lending space. Then this funding winter comes and goes for different sectors. Like possibly today MFI sector is having a bit of a challenge, or the NBFC sector is having a bit of a challenge. Some other sectors would have that, and it is our job to figure out which are the ones which would provide that growth for the next 4 to 5 years, and then invest in them. And the other sectors will get into a mature stage, again get into a consolidation phase, and again you will see a growth sector. So this is, otherwise as an overall financial sector, it's a mature business, and the technology intervention and whatever happens, that create these subsector opportunities, and it is our job to figure out where to invest in. So in the nutshell, I would say that the multiple opportunities are being created at this point in time. It's a very interesting and exciting time to be in. We remain focused on looking at more opportunities.
Thank you. So post-COVID, people have customers, people, everyone has become aware of the financial awareness and fintech. So that has also helped everyone a lot. And I think what I can get from your answer is there is a still long way to go in the financial services sector post-COVID. And now we are catching up with the trend which used to be before. Another question for you is, oftentimes businesses and private equity venture capitalists are not on the same page. So how can business objectives and interest of PE VC firms can be aligned?
So ideally they should be fully aligned, because the PE VC funds are equity investors and they are taking a share of the business. So their aim has to be aligned with the management aim, and only in situation where that aim is aligned that you should invest in. But obviously there are times when after investment you feel that that's not what is happening, that your thought process is not in sync with the management, and if the reason for that is governance, as Anurag as well as Abhishek mentioned, if that is the reason, then we need to take steps to correct that piece, because long-term value cannot be created unless that piece is sorted. Ethics, governance, and how to do business, how to report revenues, whether you are sort of upfronting revenue or not. So all these issues have to be tackled. Sometimes we obviously hear that some of the founders might say that because of PVC funds insistence of growth that we have to do it, but I do not see that. We do not like to operate in that sense, because only if we believe that a long-term value will be created that we should be partnering it. And it is then the whole ecosystem's job that we ensure that finally you will be taken out either by public investors or by some other PVC fund as a strategic thing, or some other strategic buyer buying it. So unless you create a long-term value, it will not work out. So it's a continuous job as a portfolio management to ensure that alignment is always there, and the communication channel is open both ways with the partners. That's what I would say.
Thank you. So alignment, objective alignment should be there. It's necessary. to go ahead. And even if there are conflicts, they can be sorted out in going ahead by discussions and communications. Thank you, Mr. Rishabh, for your insights. We have Shreyash Chandak now. And Shreyash, if you can unmute yourself. Thank you. First question for you is, much like investors can compare mutual fund with similar styles and objectives, investors should be able to make decisions about investments by comparing impact. What are your thoughts on addressing the challenge?
Yeah, great. Thanks, Ojaswar, for having me. Really appreciate it. Thank you for putting together this panel. I don't have much in comparison to the depth of the experience that has gone before me. But so to sort of quickly introduce ourselves and the work that we do. Village Capital is a global impact accelerator and a venture capital firm. We operate, we are headquartered out of Washington, DC, but we operate in multiple emerging markets that includes LATAM, Africa, Middle East, South Asia, and Southeast Asia. We have an affiliate fund, which is a $20 million global fund, to which we have made 120 investments across the globe. In India, we have 18 investments, and some of the more popular ones that you might have heard of, especially in financial services space, are M-Pocket, Finvigo, which is now Anthem, and then Satshore. So these are some of the companies that we have worked with. Financial inclusion and financial health is a major focus area for us. And the value proposition that we bring forward when we work with our companies is by unlocking international corridors of capital and partnerships for them, right? I head their South Asia programming, and I've been in space for about 7 years now. Coming back to your question real quick, I think one of the biggest challenges, if you want to call it a challenge with impact, is the fact that it's very subjective in nature. What constitutes impact for you may not constitute for me. And that's okay, right? But that also provides a challenge to ecosystem players as us who are trying to bring about a larger, more coherent narrative to the space. So while what constitutes that impact data, that's probably a challenge. The methodology of how we go about doing impact assessment studies is also not, say, very standardized in nature. Right? It sort of varies from firm to firm, it varies from individual to individual, and the consultant to consultant who's sort of operating in the space. Another sort of challenge probably is the fact that these impact assessment studies are very expensive to do in nature, right? Early stage founders will not have the capacity or the resources with them to get these studies done, so that they can articulate that impact in front of others. Not even small-sized funds will not have that capacity to do that, right? So if I have to sort of address them and if I have to call out possible solutions within this space, my first thought process would be, can all the ecosystem players, that includes large philanthropic firms, that includes impact investors, founders, consultants, come together on a platform and decide on a common definition of impact, common matrices of impact, which is sort of difficult in nature. It will require a lot of time and effort. Imagine, like in the financial services space, if there are credit bureaus who provide credit ratings, can there be sort of impact assessment agencies providing such outcome indicators or outcome level scores to companies, and that sort of helps gauge the impact that they have that's out there. And this sort of an idea is not new. This is not original in nature. This sort of an idea is probably what's the underlying idea of an idea like social stock exchange, right? And a social impact bond, where there are efforts to sort of institutionalize this process of gathering data, of gathering impact data and showcasing it to the world out there. My second point over here is, it's honestly completely okay if the standardization does not happen. The thing is, investing in general and early stage investing in general is supposed to be very risky in nature. If the thought process or the idea that having impact data can sort of mitigate the risky nature of an investment deal, probably may not hold true. So while it's good to have, it's necessary. I would also sort of get behind investors who are sort of operating in this space and sort of nudge them to say, be very comfortable with the kind of data that's being reported by the founders themselves. It's not necessary to say have very standardized frameworks and follow them very specifically as such too. So yeah, that's my thought process. This can be addressed through say standardized frameworks of impact assessment and impact data, but it's also completely okay if it's not there.
Thank you. So according to you, standardization is not necessary for the whole process, and it can vary from an opportunity to opportunity. Okay, thank you. Another question for you will be, so enterprises often lack skilled individuals with sufficient on-the-ground experience to understand the nuances issues facing impact investment. So how can these challenges can be overcome?
Right. So I think the problem is twofold. It also lies with investors who are not able to sort of communicate to founders real well. And it also sort of also falls on the founders themselves who are not able to understand the logic and the reasoning behind investor making decisions. Because the founders are the ones who are in the need of the capital. It's the onus lies on them to sort of address this issue, right? Again, in my mind, I think this is more of communication gap than say a talent gap, as you are probably calling it. You can take your current team, sort of engage with them, build their skill sets to understand this investment language better. That's what we tend to do in our programs when we work with our companies. When they are out there in a fundraising form, we ask them basically to ensure two things. One, do a complete research to the investor that they are speaking to, understand their thesis, understand their portfolio, understand where they are fitting into the portfolio of the investor that they are speaking to. Second, we tell them to do more holistic research on their own businesses. The thing is, when you're in front of seasoned investors, in one maximum two conversations, probably the weaker aspects of your businesses come through. The only thing that you can do is probably research and prepare yourself for those questions well in anticipation and have responses that are there. Prepare responses better, right? There are 7-8 parameters that investors typically sort of fall back upon, right? This team, this problem, whether that's excitable to the investor or not, the product, the value proposition of the product, the business model, the scale, what sort of scale can the business achieve, and probably investor exit plans, right? All of that needs to be communicated well too. There are obviously investors, depending upon the stage that you are in, who sort of prioritize certain parameters but it broadly tends to fall within these 70 parameters. When it comes to say impact-driven enterprises, impact is another sort of parameter. So have that impact data, articulate it well, and that sort of communication gap should reduce, in my opinion. That's all I will have to say on this. I think also keeping in mind in time, I can probably say a lot more, but I will keep it brief.
Oh, it's okay. Thank you, Shreyansh. So with this, we are coming to the end of this webinar, and I hope everyone had a great time, great experience. All of you shared a lot of insights on the financial services sector, impact investments, the future of this, and the pre-COVID, post-COVID, what are the changes, what have happened in the past few years. So we had a great discussion, I guess. And thank you everyone for joining. Thank you, Mr. Anurag, Mr. Abhishek, Ms. Shikha, Mr. Frishabh, Mr. Shreyans, thank you once again, all of you, for joining, for taking out your time for this.
Thank you for having us. Thank you.
Thank you, Joshua. Thank you.
Thank you. Bye-bye.